listeners. I would like to welcome you to our second accounting series for grade 10 and 11 and anybody else who has an interest in the subject. My name is Natalia Mutana, and today we will learn about recording adjustments in the General Journal. You should please have your pen, notebook, as well as your calculator ready. And remember to always take note of important points during the lesson. At the end of this program, you should be able to 1. Explain the term adjustment. 2. Explain the following concept, which are accrued expense, prepaid expense, accrued income, as well as income received in advance. Finally, prepare the general journal entries for adjustment. Good morning, class.
Good morning, Miss.
Listen to the following scenario and please give me the possible answer. John is an inexperienced bookkeeper, and at the end of the year, he realized that he did not pay the business telephone account and realized that the net profit was wrong. So John is now wondering on how he should solve this issue. Jasmine, how will you go about advising John on what to do?
I think John needs to be advised on how to treat adjustment at the end of the year in order to be able to calculate the correct net profit for the business.
The telephone account was not paid, therefore it is outstanding, and I think he should record it in his books, otherwise he will calculate the wrong profit or the wrong net loss.
Thank you, Jasmine and Philip, for those good answers. Our lesson for today, we will look at how to do journal entries to correct the adjustment. Can we first please define the term adjustment?
Adjustment can be defined as a term used to refer to the updating of accounting records with the information that was not included in these records at a specific date, usually at the end of the financial year.
So in simple words, I can say adjustment means to correct amounts either by adding or subtracting from the balance so that the correct net profit can be calculated.
Thank you very much. There are 4 adjustments that affect our net profit. These adjustments can either increase or decrease the affected accounts, which are mainly income and expenses. What do you think are these adjustments, and can you please give me a brief definition of it?
Okay, miss, I'm going to start with an expense. I'm going to try, then maybe Jasmine can try other things. I will start with an expense. We have an accrued expense. It is an adjustment that must be made. An accrued expense is an expense that has taken place or that has incurred but has not yet been paid by the end of the financial year.
The other one is prepaid expenses, and it is defined as expenses that are not yet incurred but already paid in advance for the next financial year.
Thank you, Jasmine and Philip. Well, the other adjustments which is not mentioned is income received in advance and is defined as income not yet earned but already received for the next financial year. Another one is accrued income, and this is when income is earned but not yet received by the end of the financial year.
Miss Mate, I just want to know under which type of accounts these adjustments are classified.
I think prepaid expense are current assets and affect expenses.
Very good, Philip. Prepaid expenses and accrued income are both regarded as current assets, while accrued expense and income received in advance are regarded as current liabilities. The same basic rules that we have applied to all other assets and liabilities is also applied to this adjustment.
Does that mean accrued expense and income received in advance increases on the credit side?
Yes, because they are all treated like liabilities. Prepaid expenses and accrued income increases on the debit side because they are all treated like assets.
Oh, okay, Mesne. When we record the entries in the General Journal, do we also start with the account to debit, account to credit, and the narration?
Very good, Philip, yes. The same General Journal rules apply. Remember that prepaid expense and accrued expense will always affect the expenses, while accrued income and income received in advance will affect the income. For example, if insurance of 200 Namibian dollars was paid in advance for the next year, the first step we need to do is to identify the 2 accounts involved And by that, we need to identify the adjustment that deals with expenses being paid in advance. Which adjustment is that? Jasmine?
I think it is prepaid expense.
Very good. The second step is we need to identify the expense involved. And in this case, it is insurance. Now we have our two accounts, and we now need to decide as to what account is to be debited and what account is to be credited. Who can remember on which side does prepaid expenses increases?
Me, miss. Because when we prepay an expense, we have given money for something we not received yet. Prepaid expense will increase on the debit side because prepaid expense is regarded as a current asset.
So in the general journal, we'll debit prepaid expense and credit insurance. Insurance will decrease, but it was paid more.
That's correct. Let's look at another example. Rent for 1 month of 800 Namibian dollars was not received. Can we identify the two accounts involved? And remember, one should be the adjustment and the other one either an income or an expense. Philip?
Okay, ma'am. The adjustments involved here is accrued income because the rent was not received by the end of the financial year. The income involved is rent income.
I think in this transaction, accrued income will be debited because it is a current asset and it increases on the debit side. Therefore, rent income will be credited because it is also increasing because the adjusted amount will be added to the balance of the rent income.
Well, what you need to do is you must always know the difference between rent paid and rent received. One is paid for and the other one is received. Now let's look at the other two examples. Number 1, wages of 300 Namibian dollars for the last month of the financial year was not paid. Number 2, interest on fixed deposit of 1,200 Namibian dollars was received in advance for the next financial year. I want us to look at how we will record these entries in the general journal. Can you perhaps try this?
Okay, miss. In the first transaction, the adjustments involved is accrued expense because wages for the last month was not paid. So we'll debit wages and accrued expenses will be credited.
Very good. Wages will be debited because the 300 Namibian dollars will increase the wages account, while accrued expense will be credited because they are regarded as liabilities, therefore increasing on the credit side. What about transaction number 2, Jasmine?
Interest on fixed deposit will be debited because the 1,200 will be deducted from the balance, while income received in advance is the adjustment involved and it will be credited.
That's correct. Income received in advance is regarded as a liability and it increases on the credit side. Therefore, it will always be credited.
Miss, how do we write the narrations?
Well, the narration is just an explanation of the transaction that have taken place that could not be recorded in the other books of first entry. For example, for the first transaction where we debited prepaid expenses and credited insurance, the narration could read as insurance was paid in advance for 1 month. The second transaction where we debited accrued income and credited rent income, the narration could read as rent for 1 month is outstanding.
So basically, you just describe what has happened in the transaction?
Yes, Jasmine. That was all about recording the entries in the general journal. What have you learned today, Philip and Jasmine?
Well, miss, I have learned the definition of adjustment, prepaid expenses, accrued income, and income received in advance.
I learned more on how to identify the account to be debited as well as the account to be credited in the general journal.
Well, thank you. Well, we have come to the end of this program, but before we say goodbye, it's quiz time. Now the question for the quiz is as follows. Define the following adjustments. 1. Accrued expense. 2. Prepaid expense. 3. Income received in advance. And 4. Accrued income. This program was written by Armate Until next time, goodbye.
The Education Radio Initiative is possible with support from the Ministry of Education as part of the Education and Training Sector Improvement Program.
Good morning, listeners. I would like to welcome you to our third accounting series for grade 10 and 11 and anybody else who has an interest in the subject. My name is Natalia Mutana, and today we'll learn about the preparation of the appropriation account. You should please have your pen, notebook, and calculator ready, and remember to take always the important notes during the lesson. At the end of this program, you should be able to 1. Define what a partnership is. 2. Know what is included in the partnership agreement. 3. Explain the purpose of the appropriation account. And 4. Prepare the appropriation account. Good morning, class.
Good morning,
Miss. Can we all take our seats? Well, there are different forms of businesses other than the sole trader. What do you think are those forms of businesses?
Miss, I think some may include a manufacturing and a partnership business.
Miss, I also know of companies and close corporations.
Thank you, Jasmine and Philip. So today we are going to look at the recording of transaction in partnership. What do you think are the partnership businesses?
I think a partnership is a business that is owned by 2 to 20 people.
Very good, Philip. People opt for partnership businesses because of various reasons such as more capital is invested, shared risks, etc. What other reasons can you think of, Jasmine?
I think in partnership, the responsibilities are also shared because each partner does what he or she knows best.
Thank you, Jasmine. The partnership is always guided by the partnership agreement, which contains details of constant information between the partners. What do you think is the information recorded in the partnership agreement, Jasmine and Philip?
Well, the partnership agreement could perhaps maybe include information such as the amount of capital to be invested by each partner and how profits and losses should be shared.
And also the rate of interest to be paid on capital, drawings, and partners' loans to the partnership. It also includes any salaries to be paid to any partner for any services offered.
Very good. That is very true. At the end of the financial year, after the preparation of income statement, the partners prepare an appropriation account, and the purpose is to show how the profit or losses of the business are shared amongst the partners. Is there anybody who has an idea of how the appropriation account is prepared?
Yes, Miss, I do know. I've been reading on it quite a bit. So to prepare an appropriation account, you will need the profit from the income statement, add the interest on the drawings of both partners, and deduct the interest on capital of both partners.
The partner's salary should also be deducted from the profit.
Man, I sometimes get confused on how to share the adjusted profit between the two partners. Miss, how could I make that possible?
Thank you very much. The appropriation account can be done in two formats, either in a vertical or horizontal way. Today we are going to focus on the vertical format. There are 3 columns that are used to prepare the appropriation account. You always start by placing the net profit from the income statement in the 3rd column. Secondly, you calculate the interest on drawings of the partners and add to the profit from the income statement. And then you take the interest on drawing, which is then placed in the second column, showing clearly each partner interest. By the way, how do we calculate interest on drawing?
Okay, miss, let me try this. You take the drawings of each partner and multiply with the rate of interest on drawings given in the agreement.
And the rate should always be over 100.
Very good. For example, the drawing of Sam is 100,000 Namibian dollars and Tom's drawings is 8,000 Namibian drawings. The rate given is 5%. Now calculate the interest for each partner.
Well, let me try this, miss. For Sam, we take 10,000 times 5 divided by 100. While for Tom, we calculate 8,000 times 5 divided by 100. So for Sam's interest on drawings will be 500 Namibian dollars, while for Tom it will be 400 Namibian dollars.
Thank you, Jasmine. If the net profit from the income statement was 30,000 Namibian dollars, we then add 900 Namibian dollars for interest on drawings, and the new net profit will be 30,900 Namibian dollars. Then the next step will be we deduct the interest on capital and the partner salary, if any, from their adjusted net profit. Therefore, the interest on capital is then calculated from the capital invested by each partner multiplied by the rate. So, Philip, can you perhaps tell us how much the interest on capital is if Sam's capital is 20,000 Namibian dollars and Tom's capital is 15,000 Namibian dollars at the rate of 10%?
Yo, I'll try, ma'am. We would take 20,000 times 10 over 100, which would give us 2,000 for Sam. And for Tom, we'll take 15,000 times 10 over 100, which will give us 1,500 Namibian dollars for Tom now.
Very good. The interest on capital of each partner is recorded in the first column and the total transferred to the second column. The partners are entitled to a salary if they've offered any additional service for the business. The partner's salary should be deducted from the adjusted profit and therefore should be recorded in the second column under the total of the interest on capital. The total of interest on capital is 3,500 Namibian dollars, and let's say the partner's salary for Tom was 5,000 Namibian dollars per year. It will then be added together and transferred to the third column and then deducted from the 30,900 Namibian dollars. Therefore, the adjusted net profit will be 30,900 Namibian dollars minus 8,500 Namibian dollars, which gives us then 22,400 Namibian dollars. And this is the profit that will be shared amongst the partners.
So, miss, I was wondering, is the profit or losses always shared equally among the partners?
Well, there are three ways on how partners share the profit or the losses. Profit can be shared equally, as Jasmine said, or profit can also be shared according to the capital invested or in a given ratio.
To share the profits and losses equally, we divide the adjusted profit by 2, and to share by ratio, we multiply the profit with the ratio of each partner. But I don't understand how to share the profit according to the capital invested.
Yeah, yes, miss, me too. I also don't understand.
Okay, let me explain how to calculate the share of profit or loss according to the capital invested. What you do is you take the capital invested by the partner, multiply by the adjusted profit divided by the total capital invested by the two partners. Like in this case, the total capital invested is 20,000 Namibian dollars plus 15,000 Namibian dollars, which then give us an answer of 35,000 Namibian dollars. Now for Sam, you take the capital he invested, which is 20,000 Namibian dollars, multiply by 22,400 Namibian dollars, divided by 35,000 Namibian dollars, which then give us the answer of 12,800 Namibian dollars. And for Tom is 15,000 Namibian dollars times 22,400 Namibian dollars divided by 35,000 Namibian dollars, which then give us the answer of 9,600 Namibian dollars. Therefore, the share of profit or losses is then recorded in the second column and the same total transferred to the third column. That is basically all about the appropriation account.
Sure. That was quite a lot, but I have learned a lot today.
Yeah, ne.
Can someone please refresh our minds on what we have learned today?
Okay, miss. I have learned that a partnership is owned by 2 to 20 people. The partnership agreement includes the capital that should be invested, the rate of interest to be calculated on the capital, drawings, and on the interest loan. I also learned how to prepare an appropriation account.
Very good, Philip. Jasmine, do you perhaps want to add anything that you have learned today?
Yes, miss. Apart from what Philip has said, I've also learned that the partnership agreement also includes the partner's salary and how the profits or losses are shared. I also learned how to calculate the profit or loss share according to the capital invested.
Well, we have come to the end of today's program, but before we say goodbye, the question for the quiz is as follows. Please state the 3 ways in which profit and losses could be shared in the partnership. This program was written by Armate. Until next time, goodbye.
The Education Radio Initiative is possible with support from the Ministry of Education as part of the Education and Training Sector Improvement Program.
Good morning, listeners. I would like to welcome you to our first accounting series for grade 10 and 11 and anybody else who has an interest in the subject. My name is Natalia Amutana, and today we'll learn about recording transactions in the debtors control account. You should please have your pen, notebook, as well as your calculator ready, and remember to always take notes of the important points during the lesson. At the end of this program, you should be able to 1. Explain the purpose of the control account. 2. Know the advantages of control accounts. 3. Describe the term debtors control account. 4. Know how to prepare the debtors control account. Good morning, class.
Good morning, miss.
I would like to welcome you to the class, and may we please take our seats.
Miss Maid, yesterday we learned about debtors ledger and creditors ledger, which provides the amount owed by each debtor and amount owed to each creditor. But I just have a question on how businesses go about calculating the total amount owed by debtors or owed to creditors on a monthly basis.
That's a good question, Jasmine, because imagine all those many debtors and creditors that a business might have. The business probably might make a mistake on calculating the total amount owed by the debtors or owed to the creditors.
Thank you so much. Those are actually good questions. That is why the businesses are required to prepare control accounts. Control accounts provide summaries of entries of debtors and creditors in the business. Well, control accounts are prepared from the books of first entry such as Debtors Journal, Creditors Journal, Cash Book, General Journal, as well as return journals. Now, when we talk about return journals, we are talking about the debtors' returns as well as the creditors' returns. For example, the businesses gets the total of these books and transfer each to the control accounts in order to calculate the totals of both debtors as well as creditors.
Oh, okay, Miss Bate, I see now.
Well, control accounts have numerous advantages. Philip, can we please mention a few?
Okay, miss. When a business prepares control accounts, the total of debtors and creditors will be easily provided, and the errors concerning debtors or errors accounts can be easily located and identified.
I think by preparing control accounts, fraud could also be easily detected, and summaries of the transactions relating to debtors and creditors could be provided.
Thank you very much. Well answered indeed. There are two control accounts, namely the debtors control account as well as the creditors control account. Now, the debtors control account summarizes all the transactions with the debtors, while the creditors control account summarizes all the transactions with the creditors. Please take note that control accounts are prepared at the end of the month. So today, we will look at the debtors control account only. Philip, what do you think is recorded under this control account?
Okay, ma'am, let me try. I think all sales to the debtors would be recorded in the debtors control accounts. So all sales made to debtors are recorded in the debtors control accounts.
I think only when it is credit sales. Isn't it, Miss Maid?
Very good. Remember, when we are preparing the debtors control account, we want to find out how much the debtors owe us in total. Cash sales will not affect the control accounts because the money is already received and not owed. Philip, can we think of any other transaction that affects the debtors control account?
Okay, ma'am. When debtors pay, for example, the account by either cash or EFT, as well as any bad debts that are written off.
How about Jasmine?
The value of goods returned by debtors and any discount allowed to the debtors.
Thank you, Jasmine and Philip. Good answers indeed. The debtors control account is prepared in the T account format. Well, on the debit side of this T account format, we record the transactions that are increasing the debtors. Jasmine, which transaction that were mentioned earlier do you think will increase the debtors account?
I think the sales on credit will increase the debtors account.
Good. Not only the sales done on credit will be recorded on the debit side of the debtors control account, the cash sales is received already and therefore not owed, so it will not appear in the debtors control account. What about the interest charge on the debtors overdue account, Jasmine?
I think it will also increase the debtors account because the debtors were punished for late payment and their balances will increase. Therefore, it will be recorded on the debit side of the debtors control account.
But miss, what about the balances brought forward from the previous months?
Thank you very much for that question. The balance brought forward from the previous month at the beginning of the month are always recorded on the increasing side of the account. If there was an overpayment at the beginning of the month, they are always recorded on the decreasing side of the account as a balance. So sales on credit, balance brought forward, interest received, as well as cash refund to debtors for overpayment are both recorded on the debit side. While on the credit side of the debtors control account, we record all the transactions that are decreasing the debtors control account. Can you perhaps mention any of those transactions, Jasmine?
When debtors are paying off their accounts, as well as any discount allowed to them, the debtors account will decrease, and when debtors are returning goods to the business, the value of those goods will decrease the debtors control account as well.
Good, Jasmine. Are there any other transaction that you can think of, Philip?
Miss, I also think when debtors are written off, the debtors account will decrease because now we have fewer debtors.
Thank you very much. Cash and EFT. Now remember we said EFT stands for Electronic Funds Transfer, receipts from debtors for payment of their account, discounts allowed, balances brought forward at the beginning for overpayment, sales return, as well as bad debts will all be entered on the credit side of the debtors control account because they decrease the account. Now, tell me, how do we determine the amount owed by the debtors in total?
I think we need to balance the debtors control account by following the 5 steps of balancing any general ledger account.
Oh, wait, I remember those 5 steps. So I remember how we balance that. We add up the debit side of the account and we add up the credit side of the account. Then we look for the smaller side. We subtract the smaller side from the big side, and that will be regarded as a balance now.
Very good, Philip. Remember, debtors are assets, and assets increases on the debit side. Therefore, the balance carried down should be on the credit side, while the balance brought down should be on the debit side.
Miss, that was a very interesting lesson.
Class, what have you learned in today's lesson?
Jasmine, go first.
I have learned the definition of control accounts, the purpose of control accounts, and that the accounts that increases the debtors are recorded on the debit side of the debtors control account. The accounts that decreases the debtors are recorded on the credit side of the debtors control account.
Okay, man, my turn now. I learned about the advantages of control accounts, such as to reduce fraud.
Well, thank you for your contribution, and we have come to the end of this program. But before we say goodbye, here is the question for the quiz. State any 2 advantages of control accounts. This program was written by R. Mate. Until next time, goodbye.
The Education Radio Initiative is possible with support from the Ministry of Education as part of the Education and Training Sector Improvement Program.
Good morning, listeners. I would like to welcome you to our 4th accounting series for grade 10 and 11 and anybody else who has an interest in the subject. My name is Natalia Mutana, and today we will learn about the preparation of the manufacturing account. You should please have your pen, notebook and your calculator ready, and please remember to always take notes of the important points during the lesson. And at the end of this program, you should be able to 1. Define what the manufacturing business is. 2. Explain the purpose of the manufacturing account. 3. Prepare the manufacturing account. 4. Explain the unit cost. 5. Know the purpose of calculating the unit cost. And finally, to calculate the unit cost.
This morning, as my dad and I were driving to school, we passed by a Coca-Cola in Commersdal, and we started having an argument about whether Coca-Cola is just a business like ShopRite, Pick n Pay and Spar. So my question is it though, or is it more like a manufacturing business?
Many people only know sole traders, business and company, and they don't know much about manufacturing business. Can we ask Ms. May more on that today maybe, so that he can emphasize on that?
Yeah, we definitely should.
Good morning, class.
Good morning, Miss.
Philip and Jasmine, what are you discussing there?
Well, Miss, I just have a question on whether manufacturing businesses are the same as businesses like ShopRite and Pick n Pay.
Thank you for the question. There are businesses that buys and sell goods to customer, for example, ShopRite, Spar, just to mention a few, while some produce their own goods and sell to the customer. Can you please give us an example of businesses that produce their own goods and sell to the customers?
I think businesses like bakeries or Coca-Cola and factories are examples of manufacturing businesses.
Very good. In fact, today we are going to look at the preparation of the manufacturing account in the manufacturing business. What do you think are manufacturing businesses, Philip?
The manufacturing business is actually the business that buy raw materials and turn them into finished goods or finished products. After that, they sell these finished products to the customers.
Very good. Manufacturing businesses have to calculate the production cost of goods completed, and for that, a manufacturing account is needed to be prepared. Now, the production cost of goods completed, which is then calculated in the manufacturing account, is then transferred to the income statement in order to calculate the cost of sales.
Okay. What is really the main purpose of calculating the production cost of goods completed?
Philip, thank you for that good question. The purpose of calculating the production cost of goods completed is basically to find out the total cost involved in the manufacturing of the goods.
But Miss, I have a question. So Miss, my question is the manufacturing account different from the income statement?
Yes, it is different. Now remember, the purpose of the income statement is to calculate the profit or loss made by the business, while in the manufacturing account, we actually determine the cost of goods produced. In the manufacturing account, we use all the accounts that basically affects the production of the goods. Can you think of any examples?
I think raw materials, purchased, and factory expenses. Am I not correct?
Well, Miss, I also think the money used to pay the workers involved in the production of the goods.
Very good. The manufacturing account has 4 parts. The first part is a calculation of the cost of raw material consumed, which then includes any related information that concerns the raw materials. What could be that information?
The information would be raw materials purchased and any closing stock of raw materials.
To add on that, I think there should also be raw materials brought forward from the previous year as well, and also any other cost of transporting these raw materials.
Thank you very much. The cost of raw materials is calculated as follows. We take the opening stock of raw materials, then we add the purchases of raw materials, add the carriage on raw materials, which is the cost of transport to bring the raw materials to the business, and then we deduct the closing stock of raw materials.
Oh, so the word raw materials should always be written because the manufacturing account is different from the income statement.
Yes, that's true. The second part is to add any direct costs that were involved in the manufacturing of the goods. What do you think are these direct costs, Jasmine and Philip?
Well, direct costs, according to my understanding, are costs which are directly linked to the manufacturing of a product. For example, royalties and wages.
And what are royalties?
Well,
royalties
is a payment made to the owner of the brands for each product produced. The direct costs are then added to your cost of raw material, and the result thereof is called the prime cost.
But Miss, how do we define prime cost in general?
Prime cost is actually the cost of direct raw materials and direct labor spent on a product in the manufacturing process. The next step is to add the factory overheads to the prime cost. I want you to explain factory overheads and give me some examples, please.
I think factory overheads are just like expenses which are associated with the manufacturing process, but they are not part of the cost of the finished product. For example, could be rent or either insurance for the factory.
Oh, I agree with you, Philip. And also other examples could be indirect wages and salaries, electricity for the factory, and depreciation on non-current assets of the factory as well.
Very good. All expenses which are part of the factory should be added to the prime cost. Now, the business has also expenses of the factory and that of the office where administrative works are done. The expenses of the factory are accounted separately from the expenses of the office.
But Miss, since all these expenses are under one business, how are they shared among the factory and the office?
Well, the business can divide the expenses equally according to a given ratio or according to a given percentage or in a proportion of the floor space occupied by each facility. Some expenses such as bad debts and advertising, to mention a few, are only linked to the office, so they might not be shared. Moving on, the businesses sometimes have work in progress, which must also be recorded in the manufacturing account. Can anyone please explain what work in progress is?
As the word progress said, work in progress is work which are not fully completed by the end of the financial year.
Very good. Work in progress is products where the production process has begun but has not been completed at the end of the financial period. Therefore, we have opening inventory of work in progress, which is then the value of unfinished products brought forward from the previous year, and it is then added to the answer we got from adding factory overheads to prime cost.
Is there also work in progress at the end of the financial year?
Yes, we also have closing inventory of work in progress, which is then the value of finished products at the end of the specific financial period. And it is deducted after adding opening inventory of work in progress. The answer we get is then called the production cost of goods completed. And this is what we then transfer to our income statement.
Now, does that mean the answer is only transferred to the income statement and not used elsewhere?
That is a very good question. The production cost of goods completed can also be used to calculate the unit cost of production. What do we mean by that?
I think since the production cost of goods completed is the calculation of the cost involved in the manufacturing of goods, the unit cost should be the cost of producing only one product.
Yes, you are right. Calculating the unit cost is very important because it helps the business in setting the appropriate selling price for the product in order to make a profit. Therefore, the unit cost is then calculated by dividing the production cost of goods completed with the number of units produced.
Thank you, Miss. The lesson was so marvelous, and I have learned a lot today.
Can we please reflect on what we have learned today?
I have learned what manufacturing business are, the purpose of the manufacturing account, as well as how to calculate the unit cost.
Well, Miss, I've also learned how to prepare a manufacturing account, the definition of unit cost, as well as the purpose of calculating the unit cost.
Job well done. With this, we have come to the end of this program. But before we say goodbye, the question for the quiz is as follows. Explain the purpose of preparing the manufacturing account. This program was written by Armate. Until next time, goodbye.
The Education Radio Initiative is possible with support from the Ministry of Education as part of the Education and Training Sector Improvement Program.
morning, listeners. I would like to welcome you to our 5th accounting series for grade 10 and 11 and anybody else who has an interest in the subject. My name is Natalia Amutana, and today we'll learn about calculating capital and profit and loss of businesses that do not keep accounting records. They do not keep full accounting records. You should please have your pen, notebook, and your calculator ready, and remember always to take important notes during the lesson. Now, at the end of this program, you should be able to 1. Define single entry and incomplete records. 2. Explain the disadvantages of single entry and incomplete records. 3. Calculate the capital at the beginning and at the end of the year. And then lastly, calculate the profit or the loss made.
You know what, Jasmine? I've been wondering about the school tax shop.
Really, Philip? But what about it though?
No, the thing is that I think the school tax shop is also a business. But the problem is that I haven't seen them doing proper bookkeeping. I wonder how they calculate the profit by the end of the year.
Nay, yes, you are right. Even when you buy on credit from them, they just record on a piece of paper. How do they even know the balance you owe them? I think Mrs. Mate will clarify this question for us.
Good morning, class.
Good morning, miss.
You are most welcome to the accounting class. Are there any questions from your side before we start?
Well, miss, Philip and I were just wondering how businesses like tuck shops and cooker shops do their bookkeeping. Could you perhaps shed more light on that today?
And it's so weird how they do their stuff. Do they even prepare a cash book to record money coming in the business or out of the tax shop?
Thank you, Jasmine and Philip, for those good questions. It is true what you are saying. Most of the businesses do not prepare books of first entry at all. Some businesses owners do not apply the dual asset Some businesses owners do not apply the dual aspect principle simply because they do not have the adequate knowledge of bookkeeping, and some think that it is unnecessary and time consuming.
Oh, miss. What do you mean by the dual aspect principle though?
Dual aspect principle states that for every debit entry, there must be a credit entry, and each bookkeeper is expected to apply that. These two types of businesses end up having single entry and incomplete records. What do you understand by that?
I think single entry means that the transaction is recorded on either the debit side or the credit side instead of both sides.
Very good, Philip. Single entry makes it difficult to draw up accounting records such as ledgers and trial balance that may be needed in the preparations of final accounts. The businesses also fails to calculate the profit and losses correctly. What could be some of the challenges that are faced by businesses that have single entry and incomplete records?
Let me try that one out, miss. I think it will be difficult for them to calculate the correct tax figures for the government because their calculation of profit and losses may not be accurate.
Yes, you are right, Philip. And they might also not easily identify errors and fraud made in the business. It will also just be difficult for them when they want to make decisions for the business because the figures might not show the true reflection.
Well, now let's look at how businesses with single entry and incomplete records calculate their capital as well as their profit and losses.
But why do they have to calculate the capital?
Both the capital at the beginning and at the end of the year is used to determine the profit or the losses made. The businesses prepare a statement of affairs which is then used to calculate both the capital figure by deducting liabilities from the assets.
But the question is, where will the business find the figures for the assets and the liabilities?
Interesting. What a good question. The business has to use all the records that they have regarding their transaction to calculate the figures for all the assets and liabilities in the business. For example, if a vehicle was purchased, the business must have recorded in any book, not necessarily a cash book. The business can also use a bank statement to determine amounts in the bank.
Miss, does that mean that the business uses the value of the assets at the beginning and at the end of the year to calculate both capitals?
That's true. If the business has to calculate capital at the beginning of the year, it will be the balance that were brought forward from the previous year that will be used. But what do you think are assets and liabilities of the business, Philip?
I think the business assets are the belongings, which can be vehicles, bank, inventory, as well as accrued income.
Well, the business can have liabilities such as creditors, loans, bank overdrafts, and accrued expenses.
Very good to the two of you. The business's assets includes all what was mentioned by Philip, and as well as prepaid expenses, cash, petty cash, debtors, cash float, and those are some of the examples of assets. While income received in advance is also another example of the liability that can be used.
Does that mean we use all assets and liabilities irrespective of whether they are current or non-current?
Yes, we add all the assets together and all the liability together, and then we deduct from one another. The assets and liabilities that the business has at the end of the year will be used to calculate capital at the end of the year. Again, we deduct total liabilities from total assets.
What if the assets were depreciated? How will that be treated?
Good question. The value of the asset falls every year, and therefore assets need to be depreciated. The asset value should be recorded after depreciation has been deducted. Remember that mostly depreciation is calculated at the end of the year, and therefore only the asset at the end of the year will be affected by depreciation. Now our next step is to calculate the profit or loss made for the year. Now to calculate the profit or loss made for the year, we need to take the differences in the two capitals calculated in the statement of affairs, which is capital at the end of the year minus the capital at the beginning of the year. And then we add the drawings made throughout the year, and then finally we deduct any additional capital contributed. And that is the format of calculating profit or losses.
But Miss, how can one go around being able to tell whether it was a profit or a loss made?
To answer your question, if the answer is positive, that shows that it was a profit that was made. But if the answer is negative, then that shows that it's a loss that was made.
I get it now, Miss. Thank you so much.
What a great lesson was.
Thank you so much, but what have you learned in today's lesson?
Well, I have learned about the preparation of the statement of affairs, as well as how businesses with incomplete records calculate their profits and losses.
I also learned about the definition of a single entry and incomplete records, as well as the disadvantages of a single entry and incomplete records.
Interesting. Thank you very much for your attention and for your participation during the lesson. We have now come to the end of this program, but before we say goodbye, here is the question for the quiz. How are the profit and the losses calculated in the business that has a single entry and incomplete records? This program was written by Armate. Until next time, goodbye.
The Education Radio Initiative is possible with support from the Ministry of Education as part of the Education and Training Sector Improvement Program.